Hi everyone, this is Rohit from License Mastery, and today I'm excited to have Lars Leckie, who's a partner at Aspenwood Ventures, where he brings a rare founder turned investor perspective to early stage investing. He had early co-founded AutoFarm, where he pioneered GPS and robotics in agriculture, where he built sales teams across 3 continents. He's a Stanford engineering and MBA grad. Welcome to the show, Lars.
Thank you. Glad to be here.
Awesome. So, Lars, you started your career coding and hacking, computer games before co-founding AutoFarm. So, what you drew from gaming to tractors, and how did that part, shape you into becoming an investor today?
Oh boy. Yeah. Look, I grew up, you know, what in the era where if you were going to tinker with stuff, it was, the era of games and learning to program and figuring out computers sort of at the earliest phases. I think that sort of led me to become an engineer, which is the path that brought me. I was lucky enough to have someone in my engineering school who was already down in the valley in the early 90s. And that path sort of led me down to come to Stanford, do my master's in engineering down here. And eventually just kept playing, kept tinkering, and that's that. At some point, I decided not to do my PhD in engineering, and this was mid '90s, internet time. I mean, everybody was dropping out of school to start something, and so I guess I got that bug and joined that path. The investor side was maybe a happy error. We built the first company, which, as you mentioned, was in the robotics control system space. We started the company actually to take one of my co-founders, a couple of our co-founders, thesis projects and turn them into a product. So we were landing airplanes autonomously. We were doing all sorts of landing drones for the military autonomously. The tractor piece was more, we needed a market that wasn't controlled by the FAA or controlled by the military and things like that. So it was sort of a general space. So we were building a fully autonomous tractor back in the late 90s, early 2000s. My co-founders had PhDs from Stanford. So I was sort of, although I had a master's at Stanford, I was kind of the less technical person on the team. So I ended up doing the manufacturing and the sales development and things like that. And so when we sold that company and wrapped it up, I actually decided to go get an MBA and do more of those things, for what I was going to do next in my career. And I just happened to meet, I was trying to make our product was a software and hardware product. And one of my lessons learned was that I didn't want to be in hardware at all. Just this incredible consumption of capital as you're growing. So I was looking to get into software, and I met the founder of Hummer Winblad Venture Partners, which was a software-focused venture firm. And I joined there to kind of make a transition to software and learn more and more about software. And despite the idea that I was going to leave at any moment, I never did. And so I just sort of stayed on and became more and more a venture capitalist.
Very interesting. And you mentioned at AutoFarm you were handling strategy and sales. Especially since you were doing sales and strategy for the first time, what did it teach you about building companies, and what did it teach you about sales, especially in a hardware sort of a company?
I mean, one of the lessons that I still carry forward to today is, I mean, a lot of us, if you're an engineering background or you're building a product, there's this idea that, what's the saying that comes from a long time, build it and they will come. Mm-hmm. And first off, having to go out and sell to people, that the product's interesting, but I mean, it's sort of barely the gateway drug. You have to get out and talk to the customers, and you have to figure out what problem you're solving for those people. The technology is not enough. Yeah. And so having that perspective, and then, the one we still talk to literally with my companies day in and day out today is, all your startup companies, there's a fairly bright divide. You recruit engineers, you recruit product people, and they are like very mission driven. We're going to change the world doing this. And, we're excited about building this cool thing. I'm happy to build something that hundreds of thousands of people will use, or it will make people's lives easier. How many downloads of my open source can I get? These are very mission driven things. And compare that to if you live in the sales world for a little while, sales guys, this is not a knock. They're just not mission driven in that same way. They are, what is my commission? How can I maximize my commission? How do I sell as much of your stuff? And like, I don't want to hear any of that other nonsense about product and timelines. Like, you need to solve the problem because this customer needs this and I need my $1 million order, so I can take my spouse to Hawaii or something. And that divide between those two worlds, I think, is a very useful thing. Most founders get that wrong a couple times, right? So they you build up this engineering team, everyone's mission driven, you try to bolt a sales guy on, and the motivation, like you're like, hey, why aren't you mission driven? Why aren't you doing what we're, like the rest of us? And it's just like, it's a cultural misfit, and people have to rethink how to bring those people into the fold and expand your company as you grow. Long answer, but I literally, every startup company seems to go through that phase, and so we walk through that same problem. And so having been in the world, having been a technical person who needed to learn what sales was, what talking to customers were, and so on, that's a lesson that 20, 30 years later is applicable as it was then.
Yeah, yeah. No, absolutely. Because, I come from, sales and BD, sort of an experience, right? But you mentioned something interesting that salespeople are focused, are motivated by money. But when they're trying to, join an early stage startup, should there be a different motive other than just making money for somebody in GTM and sales to come in and, start solving problems?
I mean, we just painted it as like black and white. And look, everybody, even engineers have some motivation. Hey, we want to make our stock worth a lot of money. But maybe an engineer is 80% mission, 20%, hey, can I make money? A salesperson's going to be 80%, hey, how do I get my W-2 as high as I can? And 20% mission. And look, the first sales guy you hire might be 50-50. But he's not going to be the 80-20 that your engineers are. And like that second and third salesperson you hire, they're going to start to get more and more to the 80% money, 20% mission kind of focus. And so it's, look, hiring your first salesperson is one of the hardest things because, I'm a big believer that founders need to do the first sales motion, get it moving, hear the customer, get that piece going. But hiring that first salesperson is one of the toughest challenges, and frankly, you get it wrong 50% of the time. It's more about making a decision, getting someone through the door, and then quickly correcting if they're the wrong fit. You don't do that with engineers, right? You try to get the answer before you hire that engineer, like as right as you possibly can, because it's just so painful to change an engineer.
Correct. And Lars, you held several US patents from your technical days, but when you meet technical founders, does that shared background help you see something which other investors miss, or does it sometimes make you overvalue that sort of technical expertise and elegance they have?
Yeah, it's an interesting question. I think early in my career, I could fall in love with technologies and products maybe more than I should have, and maybe with a little bit of distance from that, I see it as a strength, but I need to make sure it doesn't speak too loudly in my business decisions. When we look across what makes our companies successful, there's the old saying in venture capital that it's all about the team, the product, and the market. Those are the three things. And hey, would you take a B team in an A market? And like the answer is no. I need an A on all three. That we don't do a lot of investing. We make 5 investments a year, so we almost have to believe that the three things are, either an A or on their way to an A or what have you. But the piece where we don't invest or companies fail the most, failing meaning don't turn into big successes, is almost always on the third one of those. It's on the market size. And so our discipline has shifted over time. Although we are, your question is, can you focus just on the product and the technology? We really have, and the market's changed a lot. But our mantra internally is, can you imagine this product, this company, this category supporting a company that can be $100 million in revenue? And by the way, it has to be because that's what an IPO used to be 10 years ago or something. Like you would have to get a company to sort of $100 million revenue. And by the way, it still has to be growing at 30, 40, 50%, at that scale. So that's the reason why companies, you could have a great product and you get to 10, 20 million revenue and you kind of top the market out and the growth falls off and you're just never going to get to $100 million revenue. And so that's the lens that I try to add into that, technical question that you asked. Now, in today's market, you won't go public on $100 million growing 50%, but you will have moved into sort of the stratosphere and controlling your own destiny, and an outcome will find you if you can get to those kind of scale and metrics and so on. Yeah.
Correct. And during these times, especially last year there've been a couple of IPOs and M&As which has happened, and looks like with what is happening in the AI world, do you think public market capital is becoming cheaper than private capital? With so much of dry powder in venture, do you think the math might have flipped, where there's so much of private capital now?
I mean, we've had a few IPO, in the software space. Was it 8? Was it 10? I mean, it's still yes, it's moving, but it's like, we have a backlog of 10 years of IPOs. Like there's this huge backlog in the parent market. It's interesting. If you talk about dry powder in the venture space, an interesting thought experiment is to kind of cut the market into what used to be venture and what is now considered, at least in name, venture. So if you take the dry powder in firms up to $500 million in fund size, I would argue the dry powder is not particularly excessive or anything. And the place where there is dry powder is this market where people are raising $500 million or $1 billion or something from literally a small handful of firms. We still call them venture capital firms. I don't know if a firm can be $9 billion in fund size and still be a venture capital firm. It's something, but that's where the excess capital sits. And frankly, that capital is probably only available to 50 companies, maybe, or something, So I think the overall metrics of the venture space maybe skew that question to make it seem like, oh, well, I mean, there's billions of dollars in these venture firms that is ready to go get. But like your average startup or founder has no ability to get that capital. I think the actual sort of old school venture market, 100, 200, $500 million venture firms, it's chugging along, but it's actually in a little bit of a decline at the moment.
Correct. I mean, I wanted to follow up on Andreessen Horowitz. They raised a $50 million fund. Do you think is it possible to be middle stack where you either like Andreessen Horowitz, or you like a very small stage VC fund, sub 10 million or sub 50 million, just focusing on very selective number of startups and focusing on that?
Look, venture has always been about being somewhat non-consensus and then being right. So that's where the returns really come from. And so to your question, look, a 10, 50, $100 million fund that has a unique approach to what they look at, how they approach the market, where they're truly still doing things that feel like they're kind of betting against the world. I think that's the place where look, our fund size is, we're $75 million. We believe strongly that small funds can outperform these big funds on an overall return perspective. And part of that is because we can go into places in the market where you can, that you can still have an outrageous return, even if a company only sells for 100 million, 200 million, 500 million dollars. And so you can find pockets where the market really can support that, and so on. I mean, you start trying to deploy $15 billion. I don't think it's venture capital anymore. It's tech investing for sure. But if you're an investor in those funds, you're kind of buying a mutual fund. I mean, Andreessen Horowitz has, I don't know, 3,000 portfolio companies. You're basically buying the NASDAQ of tech startups. I mean, if that's what you want, I mean, great. I just think those investors should probably think that they're going to get kind of NASDAQ-y market kind of returns.
Yeah.
It's hard to outperform the market when you're the market.
Yeah, true. And if you look at companies like Stripe and all, they're staying private for longer. And our founders, so are they staying private for too long for the wrong reasons, or do you think there'll be secondaries and other ways? Like secondaries would be the new way of venture exit for the employees and for the investors going forward. It's like the new IPO.
Yeah, we're sort of inventing a new liquidity, new exit market. I mean, so put aside the financial, hey, how do founders and employees get their return? A lot of these are generational companies. They're going to do fantastic things. There's probably a bunch of them that are pretending to be generational companies that won't have that kind of outcome, but never mind that. I think the interesting question maybe at some point is, one of the values of taking a company public is that it's forced to sit through a certain amount of scrutiny. Being audited, for instance, having people, all the processes in place. Now it's expensive to do this stuff, but a public company is more transparent and better run and a better fiduciary of its shareholders' capital by all the processes that our society has put in place over time. And so I think maybe a more interesting question is, are these companies running like public companies with the same scrutiny, disclosure, impetus? I don't know. I think it'd be good if they did, for everybody involved. When these companies eventually get public, you hope they have run in that way. I think it's good for the people who are in there.
Right.
Yeah.
Got it. And especially when it comes to the AI world, I don't know if you've had Jason Lincoln from SaaStr saying that the triple double is dead, especially when it comes to AI. But does revenue matter as much in the world of AI, where a company can go from $0 to $1 million in months, but they can also get commoditized just as fast?
Yeah, it's interesting. We are certainly hearing, I wrote a blog piece recently on LinkedIn talking about how we're sort of in this AI, what I call the Series AI gap right now in the funding world, where the expectations are changing. So if you're a pure play AI company, the expectation is that you get to $1 million in a few months, you get to 10 million or something in your first year, and you get to 100 million. There's these stories in TechCrunch. Now, of course, they're not. It's just a few stories, but it creates this aura that everybody needs to be doing this. End of the day, I think you need to build a product that, we are all, just to speak MBA for a minute. End of the day, we are all, we are stewards of capital, and you have to, the value of a company is the net present value of the future profits of the business or something like that. So if you can get in early and raise money because you grow fast and that gives you market dominance, because now you've raised $100 million, who wants to compete with you? Many of those things are good. They're good strategies and they work. End of the day, you have to deliver value to a customer. You're going to have to generate that revenue at a profit, i.e. you have to have gross margins to support that, and so on. You can't just sort of burn money forever. And so we're looking for, just to speak for us, like, we'd love to see companies that have a product that people need, It has an ROI to those customers. Customers are paying them for it, and they're paying them with with a gross margin that is sustainable, that can create a long-term, category creating influential business that will last 10, 20 years or something like that. I don't think those things have changed. When I hear a company growing like crazy, if all they're doing is reselling OpenAI credits at a 5% margin, I mean, I wouldn't like that business before, even no matter what the growth rate is. And so, I think the next click into, are these good businesses? Do they have good gross margins? Are they defensible? Is a great strategy, countered with the idea that if you can grow at those rates and you can get disproportionate amounts of capital, you can own a space and ideally over time drive your economics to, through that sort of monopolistic view.
Got it. And especially when it comes to consumer AI, do you think OpenAI has won that consumer AI, or you have other LLM companies like Anthropic? They also have that part to winning through enterprise, and you also have a lot of the Chinese LLM models. Where do you think, especially when it comes to consumer versus enterprise, who's going to win?
So first off, I'm an enterprise software investor, so I'm a tourist and a user in the consumer space. I tend to break the AI world into infrastructure and applications. So right. Your question in my parlance would be, hey, what's happening in the AI infrastructure space? The LLMs and the turf war, and I thought when we had you mentioned the Chinese, when DeepSeek came in and had, oh crap, their model is almost as good as everyone else, and it cost 1/10. I mean, who knows what the actual cost was? But I expected that to be a shot across the bow where people went, wait, hold on, why do these companies need this much money? What's going on?
True.
The strategy of OpenAI appears to be to out-fundraise everybody so nobody even bothers to try and compete with them. There are XAI, people are doing that. There does appear to be a commodification happening in this world, so people are going to have to, if all they are doing is providing the sort of what you and I experience in an LLM right now, I think that piece commoditizes pretty fast. We're on that path, and some people will use that position to go into the enterprise or go into coding or do something that gives them a long. But I think that initial base that everyone's raised money for is probably going to get commoditized, and it's a real question of where you go from there. I'm of the belief that this war is far from over. And the late comer, the late bloomer, the person who's been here the longest. Look, so Google, I think, is someone to be reckoned with, and we are even seeing on our side, if we go in and talk to our companies about which models they're using and so on. The first answer is we're using all of them. Spending is completely unchained in the AI world right now. So if you go into a startup and you talk to them like, hey, what AI tools are you using? The answer is just like, do you turn that off when you buy this? No, we just keep using all of them. So we're sort of in the Gartner hype cycle. We are in this unrelenting spend. So everyone's revenue is up because everybody's using 2 or 3 of everything. In 2 or 3 years, my guess is that's not the case, and so a lot of that revenue will sort of, collapse and drop. And I personally think Google will come out ahead. How I think of startups, whatever, the Clayton Christensen model, we go through these periods of disruption, right?
Right.
There's an underlying shift in technology where AI, LLMs, and so on. And what usually happens is that technology jump is so high that all the incumbents are stuck and they can't make that jump. Right. And so that means that fast forward 5 years and all the winners are going to be companies you had never heard of 5 years ago. They are the new people. They're faster. They don't have customers that encumber them. Their salespeople aren't trying to sell their old business while they're trying to sell their new business. All the things that crossing the chasm is all about. And in this AI story, that means that Google, Microsoft, Meta, all these people, they are the incumbents.
Yeah.
And the new are supposed to be OpenAI, Anthropic, so on. They appear to be working. They've created that market, whatever. It's just not clear that some of the gravity of the old market, owning data centers, owning the tech stack, having customers to push your models to, are as deep as or are as insurmountable. Google's been doing versions of AI for 20 years.
Yeah.
So, it's going to be it's going to be really interesting to watch. It may be one of the first times in tech history where the disruption is not as clear cut as we have seen in prior eras.
Interesting. Also, I've seen Meta also has great distribution network and them buying, Manus and few other AI startups. It could be interesting because Mark Zuckerberg is also investing a lot into data centers. So this could be anybody's win.
I mean, the part of the dynamics of the crossing the chasm is that the incumbents don't see it happening. So if you take that story and go back into the SaaS era, circa when Salesforce started, 99, 2000, what have you. I mean, one of the things that got said over and over again was Salesforce. That's like a toy. That's being used by like teams of 10 salespeople. And if you worked for whatever Siebel or one of the the real incumbents back then, you're like, I don't get out of bed for less than $1 million deal. I need to sell to companies that have 100,000 salespeople. It needs to be an enterprise deal and so on. And they would look at Salesforce and like, it's a toy. Nobody wants their data on the cloud. All these things that incumbents say that keep them from making the decision that this is real. I don't feel like that's happening in AI at all. Mm-hmm. Like, you don't hear Google saying, this isn't real. This isn't something happening. You don't see Microsoft saying that. Microsoft is investing in all the companies. They're launching their own products. They're diving headlong in. And so in this market, in this, if it is this big disruption, the incumbents have decided to go all in. I mean, they're announcing hundreds of $billions of spend and so on. So that, I think, is the dynamic that's just very different this time.
Right. And especially like Sam Altman had said that 2025 will be the year of AI agents. But a lot of people are still not deployed those AI agents. But we've been in the world of I've been in the world of partnerships and sales, and now people are saying that you'll have say every salesperson will have say 50 AI agents working for them. When do you think that especially in the enterprises or even in startup SMBs, where people will start deploying these AI agents very actively?
That's a great question. I think you're going to see in the tech world a lot of that. As this market rolls out, so the early adopters here are certainly tech companies, and we have companies where they are actively using, they've tried, there's been many misfires, but now they're using AI agents to get, to do the tip of the spear. Hey, how do I figure out how many people I should be, let's reach out to these 100 customers. Let's find the 20 that want to engage with us. That you are able to use agents to kind of narrow that pipeline down so that your salespeople are spending their high valuable time on just the few leads that matter, as opposed to doing that bird dogging. I think that's happening, but you have to be a tech company to do that. You have to be very tech forward, so on. I think most businesses are built on the back of what I call boring customers. So the one I always use, and I'm sorry if there's someone from Guitar Center on there, but like, hey, tell me when Guitar Center is going to be using agents to drive their business, right? Because if you can land Guitar Center as a customer, they make money and they're boring, but like if you get Guitar Center as a customer, they don't churn because they're not going to be trying to reinvent their AI stack, underneath you. But if you go sell to whatever tech company, they're going to use your product for a little bit. and they might even invent they might even have an internal project to try and compete with your project and so on. And we're still in that phase of this market where it's tech forward companies trying to use agents, being sold agents by other tech companies, and that market is exciting. And but when the market makes the switch to the boring customers starting to use that, I think we're still a couple of years away from.
Got it.
And by the way, that's when that's when the market rolls into the sort of next wave here.
Very interesting. And before the call, we discussed that you were in Canada and then you moved to SF, and if you look at during COVID, a lot of people have moved out of SF, and there was a remote first culture, right? But people have moved back to SF, and people and companies are looking at a 5-day work culture. And you've been part of, you're a founding chapter member, and you're connecting Canadian founders to Silicon Valley. So what's changed about that pipeline over the last decade, and does geographic proximity to the valley still matter in this remote first world?
So first, my first comment would be, you sort of mentioned, hey, during COVID and change and tech. I think the demise or the downfall of San Francisco was greatly over exaggerated, and I think there were we've got a in the world of blogging and influencers and people, there was this, and frankly the national political spectrum, there was just this idea that San Francisco was failing and the tech was moving. I can assure you very few people left San Francisco to move to Florida, which was one of the big themes that people, it just wasn't happening. Yeah, some people moved to Seattle and some people moved to Austin, and it did happen, and companies did go remote, but it was never as great as people made it out to be. And I think equally so now, everybody's, hey, San Francisco's back, and you're like, and we're not that, we're doing just fine. It was always fine. I think we're seeing a huge resurgence, as actually most of the AI companies are back in the Valley. They're back in San Francisco, and office space is being taken down by all the big AI companies. So once again, if you follow, the cycles of Silicon Valley, what's Silicon Valley? And so you mentioned Canada. Canada is a secondary venture market. Boston is a secondary venture market. I don't even. I'm going to joke. Everyone says Florida's, but I actually, there's more tech hiring happening in Toronto than there is in Florida. So I don't know how that even got into the discussion. I think at the height of it, when people were saying, oh, the tech is moving to Florida, I looked it up, and the stats were like, tech jobs created in Toronto were like 10 to 1 for than Florida. It was nonsensical, hype. But that's strength to Toronto, as well as just the fact that I don't think Florida has that. Sorry to any Florida people. I think what you see and so we at the C100, we are trying to help Canadian startup companies, be world players. So how do you build a startup in Toronto, and how do you do it at a scale that is competing globally with anyone around? And I think you can do it, and Shopify and a bunch of these companies have proven you can. The difference, I think, between Silicon Valley and any of these secondary markets is the overlapping piece that happens in Silicon Valley. So when things slow down in the enterprise software world, they pick up in the consumer software world. And when they slow down in the consumer software world, the biotech venture market does well. And when that slows down a little bit, the green tech world comes in, and you sort of layer in all these sort of not overlapping, but all tech. The Valley has this ability to sort of kind of move through these cycles in a way that doesn't create these huge up and downs. And what you see in secondary markets is that they can win for a period of time. You have some great companies, but that doesn't translate into jumping onto the next wave. Mm-hmm. And the Valley, just time and time again, has this ability to sort of reinvent itself towards. So right now we're reinventing ourselves towards the AI, this new AI world, and it all just happens to be here, right?
Right.
And so some of the other markets that are slowing or harder to exit and so on, in your secondary market, those people aren't making that jump to the AI world in the same way. And so it look, it's why I moved here. It's why I stay here. It doesn't mean that the world isn't becoming more global, isn't becoming more globally competitive, that you can't succeed in other places and that it won't be distributed. But I think you're going to continue to see that dominance of the Valley because of that. And so my advice to people, Canadians, whatever, like build your company wherever it makes sense, have employees wherever it makes sense, but spend time in the Valley,
Right.
learn the culture, learn what's working, partner with people, like be part, like don't hide from that.
Makes sense. And what has happened in 24 and 25 was you've had companies like Bolt and Versal and Replit and Lovable, where people say that you don't need to learn engineering. You can, and especially with cloud code, it's becoming better and better, right? And recently I listened to a podcast from Elon Musk where he said that you don't need to spend time in a medical school because you'll have Optimus and robots actually doing surgery better than people. So, in your view, if you want to give an advice to an 18-year-old who's listening to the podcast, should they look at? You've been an engineer yourself. Should they do computer science? Should they get into medical school? What's your advice to young people who just getting out of college or getting to college?
Yeah, well, first off, just turn off the feed for Elon telling people to drop out of school and that robots are. He's talking his own book, so be careful listening to what he's saying because he's got a lot of money on a big platform, and by design you're going to hear a lot of it. Look, end of the day, why do you go to school? You go to school to learn to learn. You go to school to figure out I mean, you want to be an engineer. You find problems interesting. If you went to school a long time ago, you learned a certain set of skills. Technology moves forward. You have to learn a new abstraction layer, and then there's a new abstraction layer on top of that. And if you did art history, they tell you have to learn how to paint like the masters first before you can invent a new type of painting that would be this era's. That 100 years from now you look back on this era, if you did something that was orthogonal to what the masters did, but you kind of have to learn what the masters did to learn, And so I think technology, engineering, learning is exactly the same thing. So you want to have to learn. You're going to learn the tools of your era. You're going to use those to springboard into the next era. I don't think you can unlearn how to think like an engineer, whether it's applied to the physics problems you would have learned, before, or the computer science problems you would have learned. Do you have to learn core? I didn't learn assembly language, very deeply, because by the time I got there, assembly language was sort of, you had to learn what it was and how it operated to interface with the hardware. But I learned a new programming abstraction layer. I've got a kid who's in engineering school now. He's still learning a little bit of assembly. He's now learning a ton on the that next abstraction layer, but he's also already onto the hey, can I use AI coding to speed up my process? Sure, you can. So I think like an engineer. Find stuff that is like you're going to find an interesting path in your career and your life by being curious and finding riding on that wave as it sort of pushes up and crests more. I think, the what's exciting about AI is a little bit of like what happened in cloud. Maybe this is my own personal view, but like when AWS came out,
yeah.
If you recall, it was the end of software. It is done. It is too easy to write software. Not because the programming languages were changing, but because it didn't require millions of dollars to buy your own servers, rack your own server. Like it used to be, if you wanted to write software, the first thing you had to do was be a hardware engineer. You had to like stack and rack and do, and so like what you were doing in your software company required this undifferentiated heavy lifting, of infrastructure build outs, and so everyone's like, hey, AWS comes out, you don't have to do any of that, so everybody can compete on the software layer. And so end of software, done. Nobody, it's too easy, it's too fast. Well, that's not what happened. What happened instead is software went and started solving many more problems in many more areas, and we had explosion. Now, by the way, Jason Lemkin, SaaStr, we also had 20 companies doing the same thing, and so for a period of time, like, that was undifferentiated and got commoditized and played out. I think AI is exactly the same thing. Oh, it's the end of software. It's never going to be. Now you don't have to build your own hardware. You don't even have to do your own whatever. But there's always going to be people pushing that forward. And it means that there's going to be not, if you benchmark it, if there used to be 1 million programmers that could do X, there's going to be 10 million programmers can do that. And what that means is it is going to be an even bigger market in the future. So, good news. So if you're 19, get in, learn what the masters did, and just keep pushing forward, and you'll find something interesting to do that will keep your brain engaged and probably make you some money along the way.
Got it. And Lars, we see industries is really changing a lot. You earlier had 10-year cycle, and then you had earlier you can get to have $50 or $100 million in revenue and get to have an IPO. But things are really changing. Where do you see is the future of venture capital? Do you see a lot of secondaries will be the new IPO, or you'll have new ways of raising funds? Well, how do you see that unlock in the next couple of years?
I think the venture industry is going to have to bifurcate. There's going to be what someone has coined consensus capital, those the huge dollars that are replacing kind of the public offerings and the public, that exit market. That's going to, but I think that's going to be 50, 100 companies. Like, it's going to be, and we're going to see the venture market kind of split, because the people who are still trying to fund early innovation and so on, I think that market will have to kind of reinvent itself around the timelines and the exit strategies and the secondary and so on. I think that will happen. I think it will get sorted, and I think that companies that build value will find investors and exits and so on. And I'll maybe even go so bold as to, I think that the public market will reassert itself in the future as the place that is the ultimate decider, dictator, beneficiary. I think companies need to see the light of day, and that the millions of retail investors around the world are the people who should benefit and arbitrate which companies are the winners long term. And so I think that there will be a phase in the next 5 years where I don't know how it happens, but the market forces will sort of push that back to the forefront.
Got it. Lars, I quickly want to do the top 3. What's your favorite business book?
I'm not a fan of business books. Of course, Clayton Christensen, his whole series of how disruptions work are amazing. I'm currently reading, it's not really a business book, but a technology book called Why Machines Learn. It's the math behind the current AI era. Yeah.
Got it. We'll put that in show notes. And if you could go back in time when you started your career in venture capital, or you started in Aspenwood Ventures, what is the one thing you would have focused on or done things differently?
I got in the business at a time when the venture space was going through pretty interesting. We had the .com slowdown, we had the build up, and I think as a firm, if we could have focused on the shift that happened in my era, where we had the explosion of the seed funds happening, I think that was an era where we focused on building companies like MuleSoft and Five9 and stuff through those, and we sort of sat that era out a little bit. And so I think we could have been a more active participant in that.
Got it. And do you have any favorite online tools, for example, Gmail, Slack, Zoom, ChatGPT?
I would like Slack to be the answer to that question. The reality is my world is more and more WhatsApp, which I find interesting. And my preference would be that we stop inventing new messaging platforms that only mean that I have to have even more. We have just adopted Slack across our organization, and we use it to communicate with our founders and so on. And already I'm having the problem now that WhatsApp is not in Slack, and so it's this never-ending treadmill of places that I have to go to try and find. Like if you message me, it now takes me 10 minutes to figure out where we messaged. So like.
Yeah.
So Slack, hey, let's everybody agree Slack's the winner, okay?
Got it. Makes sense. And Lars, what's the best way people can reach out to you and know more about Aspenwood Ventures?
Well, my business is to be found, so you should be able to find me on LinkedIn, probably easiest, but Lars at aspenwoodvc.com, on our website, whatever, that's the way to get me.
Got it. We'll put it down in the show notes. Lars, thank you so much for taking your time and speaking to us. I really enjoyed my conversation with you.
Yeah, thanks for reaching out. I enjoyed this conversation.